Hi. So what I would like to go over in this quick lecture is first of all, the concept that in an MBA and in business disciplines, they're not all just siloed, they interact and they overlap. And so I wanted to talk about three disciplines and how they overlap. And so we get a bigger context about what we're studying and how it all sort of fits together. And what the end product of one thing is used for the other discipline and all that, and how each discipline contributes to the others. So the three I'm going to talk about are accounting, economics, and finance, right? And if you know anything about these kind of circles where they overlap, that's called a Venn diagram. And it's a really interesting way to diagram concepts. So let's talk about accounting first, right? Accounting is bookkeeping, right? It's debits and credits. It's how you take care of all the different ledgers and journal entries for all the different categories you have for every expense and every revenue item you have in your company. And so you can keep score how much money is coming into the company, how much money is going out of the company, and how much money you're making or how much money you're losing, right? It's really how we keep score in business. Accounting is the fundamental basics. Now, the end product of accounting is financial statements. That's what accounting produces. There's three financial statements, right? That we know it's the balance sheet, the income statement, and the cash flow statement. Those three financial statements tell us how a company's doing. That's we can read those for preparing for our own company, for our investors, and for our different people we work with. Or we can look and analyze financial statements on 10Ks, annual reports of publicly traded companies, and make assessments about whether or not those companies are healthy enough to invest in and how they look. So understanding financial statements and how to read and understand them is very important, right? So financial statements overlap with finance in that they are the things that basically finance starts with, right? The how much a company is making, the net income, the cash flows, all those kind of things. Now, financial statements and accounting, they are retrospective, right? That's a rear view mirror, like in a car, right? You're looking backwards, what has happened over time, and then you're saying at the end, stating it in these different financial statements, what happened over a prior period of time. So it's a retrospective activity, it's looking backwards. And for finance, we also want to look forwards, right? We want to look prospective. And prospective is projections, financial projections. What's going to happen next year and the year after, how much revenues are going to increase, how expenses are going to increase to support those revenues, and how much more money the company's going to make each year, right? That's what we want to do in our projections, right? So, and now let's see how economics fits into this too, right? Economics, there's two parts of economics basically, and parse it into two things, microeconomics and macroeconomics. Microeconomics is small economics, micro, right? It's the individual behavior and also the theory of the firm, how a firm behaves, sort of like an individual, any company behaves. That is what microeconomics deals with. It deals with supply and demand, and I'm going to do another video just on supply and demand and how supply and demand, if demand increases, then prices go up, right? If demand reduces, then prices go down. And if supply really increases, then there's a surplus, and that affects prices. Or if there's, like now, supply chain problems, if supplies are hindered or hampered, then prices go up, and we have things like inflation and all, right? So that's what happens in microeconomics. Macroeconomics, that's what that blends over. Inflation, monetary policies, employment, unemployment, those type of big, international trade, currencies, all that is macroeconomics. That's the big picture of economics, right? The big picture in economics, with finance, microeconomics overlaps finance with the theory of the firm and the theory of the individual, how individual behavior operates. Behavioral economics is a big new field where it looks at psychology and our actual behavior, our cognitive biases, all these things that interact with us. We're not just a rational entity making our economic choices. There's all these other behavioralist components that come into play, right? So with that's what how micro interacts with finance. And then macro, one of the big things that macro is talking about is interest rates. If like a central bank wants to keep inflation low, wants to keep unemployment low, keep employment high, and it does that by adjusting the money supply primarily, right? And so what it's doing is adjusting the money supply to adjust interest rates, to either cool down an overheated economy or to heat up economy that's just lagging along. The way a central bank does that is by either issuing more money into the money supply or taking money out of the money supply. And the way it does that is either by buying government bonds, right? And if it buys the bonds, it puts those bonds on the central bank's balance sheet, and it puts money that it's printed into the financial system. If it wants to do the opposite of that and take money out of the system to increase interest rates, then what does it do? It sells those bonds on its balance sheet, and other investors pay for those bonds, and that takes money out of the money supply, the overall money supply, and that puts money back into the Federal Reserve, I'm saying, but any central bank, right? And so that's when you hear a central bank, they'll be maybe saying the central bank is intending to reduce its balance sheet. Well, how's it going to reduce its balance sheet? It's going to sell some of its bonds and suck money out of the money supply to shrink the money supply. And if there's less money, right, that's supply and demand, then interest rates are going to raise. So that's how economics and macro, that's how it works with interest rates. In finance, we're very interested in interest rates, right? Because that is the basis for our discount rate when we start thinking about the time value of money. $1 today is worth more than $1 3 years from now because there's interest, right? If you invested that money in the bank now, each year you get interest and it'll be worth more than the $1 in the future, right? So if we have money in the future, we have to discount it back to present value to understand a valuation of a cash flow streams into the future, right? So that's where economics and finance overlap, is primarily with interest rates, the time value of money. So we can do our present value calculations and then do our gold standard of decision making in finance, right? Net present value. So I wanted to just give a brief overview of how these subjects overlap, interconnect, contribute to each other. And I hope that gives you a larger, oversight idea, the context of where finance, accounting, economics, how they all fit in together. I'll catch you in the next lecture.